Hey, everyone, and welcome. I'd like to call your attention to our disclaimer that clearly states that the materials presented today are for educational and information purposes only. You trade 100% at your own risk. Be clear that trading can involve serious risk of loss. Cash Flow Insiders, Gamma Capital Advisors, Gamma Option Solutions, and Hans Albrecht are not in any way investment advisors or registered brokers. It's highly recommended you consult with a financial advisor for investment, legal, or tax advice relating to options or any information in this presentation or websites listed herein. So, good afternoon, everyone. If you're on the East Coast, it's lunchtime. So, hopefully, you've grabbed a sandwich. You're digging into it while watching this as we continue going with this really great event. When David told me about it and suggested I get involved, I thought, wow, this is an interesting topic. It's really something that folks don't talk about enough because it's not so much about presenting specific mechanical ideas of how to do things in trading. So, your typical strategy that tells people do this, do that, based on a pattern, perhaps, whatever the signal might be indicating. It might be something a little bit more quantitative. I'm an options trader, so let's say when implied volatility is high and falling and realized volatility is falling faster, that's pointing to more downside and fear, and that's when we can consider certain option harvesting strategies, for example. And I love those things. I love indicators and disciplined approaches, and I think trade mechanics are a crucial part of a sound overall strategy. And it's certainly part of our cash flow insider system, which I'll talk about a little bit later. But when it comes to mindset and mental discipline, there's a lot at stake because the problem is all that other stuff I just mentioned hinges on our ability to control our emotions and ultimately execute and follow through on our intentions. I mean, if we can't handle things emotionally and handle adversity, then we're in trouble. If we're not strong mentally, we might sidestep our rules as we get caught up in the volatility, we get embroiled in the noise of markets, and we know that noise can be substantial at times. And as we get overwhelmed and things are going against us, we're prone to second guessing ourselves and doing something contrary to our plan, right? We all know that feeling. I've done it, and I'm pretty sure you guys have done it too. So Mike Tyson said everyone has a plan until they get punched in the mouth, which I think is some incredible insight from Mike into how the mind works. We go into things with good intentions and confidence, but when it starts to go wrong, we abandon doing the right things. And that's a curious thing, really. Maybe that's part of human nature, I guess, where we seem to be prone to glitches in our programming. Kind of like when we want to eat those extra few slices of pizza, even though we're trying to lose weight, we know it's not a good idea, but we do it anyway. Unfortunately, we have these blind spots sometimes when it comes to doing the right thing. And that can hurt us over time, especially in trading and investing. We're human, though. And quite frankly, human variability in behavior is a part of what makes us interesting, I guess. If we were all robots, things would be pretty boring. But with humanness, we have to start recognizing our biases. Daniel Kahneman was a Nobel Prize winning psychologist. He actually just passed away very recently. And he talked about loss aversion on a regular basis. And he gave this example of a coin toss scenario where he would say to somebody, I'm going to toss a coin, and if it's tails, you lose 10 bucks. And then he asked the same person, how much would you have to gain on winning that bet in order to play? And he said most people said at least $20, which mathematically makes no sense. The odds are the same for a heads or a tails, but people demand twice as much for winning in order to play. So let me put this in a different set of wording. In other words, it suggests we're willing to leave a lot of money on the table to avoid the possibility of losing. Most people wouldn't make this bet. If you said, I'm going to pay you $15 on a win, most people wouldn't take that bet, even though that's a bet you should accept a million times over because it has positive edge. And another way to look at this is maybe that the sadness you endure when you lose $10 is greater than the amount of happiness you gain when you win $10. That's really fascinating to think about, isn't it? And of course, there's a term for this. It's called loss aversion. And it's one of those things that affects us as traders. It's something we need to look out for. The human mind is not always rational, right? Newsflash to everyone. Of course it isn't, but we need to be reminded of that when battling those little trading demons that try to derail us. Awareness is key. Don't just watch the ticks on the screen. Keep in touch with yourself. It sounds a little Oprah-like, but it's true. Keep in touch with yourself as you're trading. So being more robotic would help. We aren't robots, at least not yet. Maybe at some point we'll be able to load some software into our brains each morning to get things done more efficiently. Maybe AI, the big thing these days, is going to be able to program us to do things that perhaps we wouldn't otherwise do. Elon, of course, is working on something along these lines with Neuralink. If this it's this sort of this concept of being able to implant a brain computer interface in our heads that will control things like an external computer. So you'll be able to command things to happen just by thinking about them, which is pretty cool stuff. Now, what if that extended to other things like hacking your brain and telling it to not want to smoke, for example? That, of course, would save millions of lives. Maybe it could prevent the mind from wandering while driving as well. That sort of thing could save lives, prevent damage, injuries. Insurance premiums would drop, right? It's nice and deflationary. We could all use a bit of deflation, that's for sure. Maybe we wouldn't need Ozempic and these sort of weight loss drugs that are taking the world by storm. Maybe the solution isn't drugs, but it's controlling the brain to specifically know not to overeat or convince us to exercise 3 times a week. I could use that. So managing those pain points. Some of this concept's a little bit scary, but the possibilities are mind-boggling, pun intended. To get back to what we're talking about today, this is how this relates to trading. Just maybe at some point it could get us to do the hard things when it comes to trading, which is my point right now, because I often like to say that trading and investing is difficult because the correct thing to do is the most difficult thing to do. And that's often why people struggle. So I'll say that again. The hardest thing is often the correct thing to do. So for example, we know that cutting or losing positions and letting the winning ones run is hard to do. We know we should do it. We've been told this many times. It's probably the most famous trading rule ever. Let your winners run, cut your losses, but we don't do it. Why? What really our minds are driven by pain points. And if a pain point overrules good decision making, then we suffer. We maybe end up making the wrong decision. So for example, we see that a position is starting to go against us. And we let it go, right? We see it breaking down through a trend line. We don't want to admit we're wrong. It's painful to admit when we're wrong and take a loss. So we start coming up with all kinds of excuses when it happens to avoid that pain. Oh, maybe that's a false breakdown. Maybe they're just shaking people out. It's temporary. It's Friday afternoon. Everyone's gone home and it's going to come back on Monday. But what we're really doing here is we're starting to trade on hope. We're hoping things get better, right? We're no longer trading on edge. Whatever edge we've identified is now disappearing. We had an idea, the moving averages were looking good, the stock was supported by the trend line. Once it breaks below that trend line solidly on volume, why are we holding on? Well, because it's hard to admit we're wrong and it's easier to make excuses. So the pain of admitting you're wrong has overruled the pain of losing money, partially because you haven't technically lost money until you click sell. It's not real yet. But one pain point has proven more powerful than the other. And guess what? Hope feeds on excuses. It loves excuses. We start making up more and more and more and more of them. Then by the close of the day, we're out a bunch of money on it. We don't want to book that loss because now it's even bigger. Damn, we could have taken that smaller loss earlier. The one you showed me earlier, I'll take that one now. That actually looks good, but we can't do that. So we become paralyzed. We hold on overnight. And the next day, things get worse. We start thinking about our wives killing us. So we pull the ripcord and we end up taking a huge loss on the position as we go from denial to the acceptance stage of our trading grief. And it wipes out all sorts of profits and progress that you've made. So the lesson here is don't trade on hope. We call it smoking the hopium, and it isn't good. When this happens, you have to ask yourself, would I put this trade on now, right? Has the picture changed? If it has, we need to re-examine and not make things worse. So ask yourself, would I put this trade on now? So clearly, a lot of success in trading comes from what's between the ears and how well we manage our emotions and cognitive biases. Is the brain game 50% of the game? Probably. Is it 70%, 90%? Who knows? I mean, it probably varies by person. But a little later, I'm going to talk about a strategy that starts to make this process of being disciplined easier because it takes a negative and turns it into a positive. I think you're going to find it interesting. So a little about me. I'm Hans Albrecht. I'm a veteran wealth and asset manager. I have an Ivy League master's degree in business, 30 years of option management and trading experience. So real in the trenches experience as a pro options market maker for 12 years, working on the old trading floor, just like in the movie, trading places, all the chaos and hand signals and all that stuff. Then a portfolio manager for 10 option overlay ETFs, so covered call funds, black swan funds, which own the market and own protection and use put selling to fund that protection. So tons of experience. I've managed $1 billion in AUM in option strategies, and I've generated $750 million in options cash flow over the years for folks from the US all the way to Canada to as far as Australia. I've been a television guest on BNN Bloomberg, on TD Ameritrade, Morningstar, other networks. I've been quoted in almost 100 articles on option selling, many other topics. I wrote a little book called Let's Talk About Volatility. I was an all-star of options trading headline speaker, written tons of articles for newspapers, et cetera, et cetera, et cetera. I've got an article coming up for Option Strat, hopefully in the next week or so. So a lot of experience. This is my passion. It's my career. I just love talking about options trading and how to generate income with options. But importantly, for anyone who cares to listen, I've done what I talk about at the highest professional level. And I think that's important. If you're going to pay attention to somebody, be careful and make sure that they've got the experience. So we talked about controlling our emotions. I call this regulating your emotional capital. We understand monetary capital. It's easy to keep score of that, right? It's dollars and cents. Emotional capital is something I see traders spending a little bit too freely by trading loose, by maintaining bad habits, by breaking rules. And sometimes we can almost blame the market, can't we, in part for perpetuating this. So for example, lately we saw a nice little dip in markets. A number of traders, a couple of students of mine, mentoring students, held on to positions that were going against them, right? And some of them were ugly positions. I call the ones ugly that get ugly, but also are positions on stocks that are maybe a poor quality kind of equity that maybe you don't want to hold for the long term. And that's the risk in selling premium on stocks like that. So we had a nice bounce back and everything's fine again in many of those cases. So what does that do? It reinforces negative habits, right? If we break a rule and we get away with it, we're likely to break that rule again, aren't we? And so that kind of thing can work until a 2022 happens and markets get clobbered for a year and you get buried. So don't get too cocky about wins that result from bad habits, right? This stuff's going to catch up to you at some point. I'm not saying never break a rule, but you got to really, really curtail that as much as you can. So rules are very, very important. And trading is a little bit like flying an airplane. I'm a private pilot, so I can tell you that when the skies are blue, the winds are calm, you can fly that plane with your pinky finger. It's easy, right? Now, when the storm clouds appear and the winds pick up and it starts to hail, and that's when the rules and procedures need to kick in. I remember this happening to me over the mountains north of Montreal, a very hairy experience, but I could feel the training take over. All those hours I spent repeating emergency procedures, they start to kick in instinctively, scanning the environment, looking for places to land, carefully monitoring certain instruments. So for us as traders, when you try to land your bad trade in a big crosswind, that's when the rules and discipline are going to keep you safe. So if you never practice doing these things, or you get away with doing the wrong things too many times, it's going to get tough. Life is going to get tough at some point. I'm pretty sure of that. So let's see how this relates to options specifically, because this actually complicates things, right? We're going to combine a couple of concepts that we've talked about here today. With stock, long or short, our payoff profile is linear. That's easy to understand, right? Up or down $5 in the stock, and we make or lose $5. With options, it's different. And this should inform how we need to react to adversity. So let me explain. With options, we have leverage. When we're long an option, we can spend $1 to potentially make $5. That's being long leverage. But when we're short an option, so if I sell a call or a put for $1, the most I can ever make off that particular trade is $1. But that option could be worth 5 or 10 on expiry or on the way to expiry even, which we're going to probably have to cover. So this is an asymmetrical performance profile, and that asymmetry can potentially hurt. So think about the meaning of this for a moment as we revisit that concept of maximizing winners and cutting losers. That takes on some special meaning because the math has changed. When I'm long a stock, I can let it run in my favor forever. I can maximize the win. There's no limit to how far it can run technically, but I can cut it loose if it goes against me. So I have a nice up to down profile if I do things well. But what about my option position? Can I let it run when it goes in my favor? Well, somewhat, but I'm maxed out at the premium received. I'm capped. I'm only ever going to receive the dollar that I took in premium. But if it goes against me, I may have to cover for much higher. So this means that we need to be much more reactive to positions that are going against us because a max loss of $5 or $10 is going to wipe out a lot of wins. I need 10 wins of $1 to make up for one loss of $10. And unfortunately, that's like pushing a boulder up a hill. So again, back to what we've been talking about, setups, discipline, framework, rules. They need to be followed and we can't make excuses. We need to keep those to a minimum. We're human, right? We established that we're human, but we need to keep the excuses to a minimum. We just need to be that much stronger at this game. Now, I'm not talking about selling covered calls against long stock positions. You're still doing fine. You're selling cash secured puts to own a stock you like lower, maybe. And I stress again that you like, that's quality, right? Don't do it on the junkier stuff unless you're prepared to stick handle that. We'll talk about that in a second. But if you're selling covered calls and selling puts and doing that on quality companies, you're probably going to be fine. You might end up owning the stock on a short put. But if you're selling puts purely for income and selling naked options, I don't recommend doing that. You're going to have to be very good at managing your risk and reward profile, having an exit plan, sticking to it. And this is a really real issue. I have students who aren't quite on board with this and what it means because a lot of them are selling options as a business. And that's quite different from selling options as an investor. Think about that. If you get a 2022 and your put positions start getting rolled over early in the year, you end up sitting on your hands a lot of the time. You can wheel it a little bit, sell some call premium, but you're going to be sitting on your hands a lot unless you have a hedging system like I teach in the system, right? You're going to be sitting on your hands because you own a bunch of stocks. You went from selling puts to owning a whole bunch of stocks. So I tell those students, you're either in the business of selling options for income and you make the hard decisions and manage things well and cut things short and take a few losses once in a while, or you're kidding yourself and you're not really in the business of selling options for income. You may have started out that way, but you became an investor when things went wrong. And if you need options income to survive, and I'm seeing more people like that, amazingly, more people are trying to do this for a living to support themselves and their families. Well, you're going to be in a pickle. So it's time to decide. And it's a serious decision. It's doable. It can be a clear decision, but you've got to make it. So I wanted to talk a little bit about something that you're not going to hear much about. I talked at length about cutting losses and letting winners go. Okay, obviously that's easier said than done. Now, taking a hit is hard, but the part that folks don't talk about enough is knowing when to take a profit and how to protect those profits. And this plays squarely into mindset and bias as well. You may not think of it that way, but it does. Let's think about this. Giving back gains triggers some of the same anxieties that losses create. Once we're up money on a position and it starts to go the other way, we find it difficult to admit we were wrong, that we didn't sell it higher, and then we let it get worse. And a lot of the time, we give up all the gains. Have you done that? I've done that. It's a terrible feeling because I didn't get the high. Oh, so I didn't want to take anything lower. And then I gave up all my gains. So what do? We try to avoid that pain of missing the high by selling too early, right? So when we start to see good gains on a position, a lot of the time, a lot of us can't wait to get out of that. We want to take that profit, right? Because we're trying to pick the high and it goes higher, but you already tried to pick the high and now you've missed out. So what do? Because that's not conducive to winning more than you lose. So how do we maximize wins in a strong trend while getting out when things turn against us? Well, we have to remove emotion from the equation, right? We're back to that again as much as possible. I'm an options trader, so I love indicators that use volatility because they adjust to the environment we're in. Most people have heard of ATR, average true range, and I like to use it both as a proxy for what kind of volatility environment we're in. You can use Bollinger Bands or VIX. Those are going to give you that too. But also for setting profit targets and stop outs. And most charting packages are going to give it to you. What it calculates is a rolling number that is based on a series of days, typically 22, but you can change that to make it more or less sensitive. And it uses the high, low, and close for each day to arrive at this number for the average range of the stock or index over that period. So what you can do is you can say, I'm going to set a stop loss at 3 ATRs. You can say, well, the average range on NVIDIA is 15. So I'm going to tell myself that I'm going to get stopped out at 45 on a drop of 45 from the recent highs. So if the stock falls from its high by 3 ATRs, 3 times 15, it sells the position. So you can kind of set it and forget it on some platforms. Nice, takes it out of your hands, right? So you don't mess it up. You don't get in your own way. A trailing stop is one of the best ways to grab a bigger chunk of a strong trend. The problem with the ATR is that it's changing every day. So it's time consuming. You got to keep figuring out what your current stop is. And the solution is the chandelier ATR. And it was created as a solution to this exact problem, which is an ATR that can move around. So the neat thing is you can have it superimposed on your chart a lot of the time, which is great. And I like to use a 5 ATR, 5 times the ATR, because I tend to be a longer term hold kind of person. I'm not trying to flip things around too much. So I like to pick a close below the ATR for 2 days in a row as a trigger to get out, right? So if you look at this chart here, we can see NVIDIA it has a nice breakout. Of course, we're picking a phenomenal breakout, but it has a nice breakout. You can start to add your chandelier ATR on the breakout. You can tell the system, look, give me 5 ATRs, and that's where I'm going to get out, which would take you back down below the trend line if you got in around here. Or you can wait until it sort of starts to consolidate a little bit, then you add your chandelier. It's up to you. I like to add it on the breakout after a couple of days. In fact, you can tell yourself, well, I'm going to wait for 2 ATRs of upward move, and then I'm going to add my 3 or 4 or 5 ATR stop out after that. And so you'll notice that on the chart here, the green line is the chandelier ATR. And so you can see over in the top left corner that we've got our 22-day period, and you've got the 5 times ATR. So you can program it. 2 ATRs, 3 ATRs, 4. If you want it to be super, super conservative, you can make it higher than 5 even. And so here it is. It's kind of following the stock up. And we can see that NVIDIA was extremely strong. It didn't give you much reason to get nervous. But let's say you're in this stock. You've made 100, you've made 50, 75, 100, $125. Of course, you're going to want to sell in here, but you're going to give up a lot of potential upside. And that's what a trailing stop does. I'm sure some of you have come across a trailing stop. Over here, we can see that NVIDIA does take a little bit of a hit. It does not trigger the chandelier. So the 5 times ATR is good for that. Now, a smaller ATR might have stopped you out. And we keep going, and going. And over here, we don't show it on the chart, but it actually triggered and got us out. I think it was in the low 800s, somewhere around there. Actually, it didn't get us out. It triggered below the ATR, but we only had one close below the ATR. That's why I like having 2 closes in a row below the chandelier ATR, because a single drop could be, a fat finger, could be a little mini flash crash, something going on. A second one is telling you that, well, there's some weakness here, right? So we didn't get stopped out in this particular case. So give the chandelier ATR a good look. I find it's a really, really cool and a neat system that adjusts to the volatility environment. I always love stuff like that.